Hi, everyone. In today's episode of the Brisbane Property Podcast, we have invited special guest Evan Lucas, who is a behavioural economist. And today we are going to discuss so many things in relation to economic conditions, including interest rates, and how these things impact consumer behaviour when it comes to purchasing property and also property price movements. This is an episode full of value. We hope you enjoy.
Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hello, everyone, and welcome back to another episode of the Brisbane Property Podcast with Scott and Melinda Jennison. And today we've got a special guest. We've got Evan Lucas. Welcome, Evan.
Hello, Scott. Hello, Melinda. How are you?
Very well.
It's wonderful to have Evan join us for the very first time on the Brisbane Property Podcast. Now, for those who may not know Evan, he's a keynote speaker in behavioural economics. He also talks to economics more broadly, financial markets, public economies, and more. And he's got more than a decade of experience in global markets as well. So we're really grateful that he's given up his time today to share some insights with us on the Brisbane Property Podcast. Now, for those that are avid readers, you may be more familiar with Evan's book, Mind Over Money, Why Understanding Your Money Behaviour Will Improve Your Financial Freedom. And it's a book that we recommend that you grab from your local bookstore. It's got some fantastic insights to help you understand your money management style. So welcome to the podcast, Evan. We're excited to unpack a really interesting topic today, all about interest rates.
Yeah, it will be quite interesting. Before we go any further, I love talking about all this kind of stuff, and I have a very big connection to Queensland as well. If you do want to hear me, besides obviously with Belinda and Scott, which I'm really excited about, I do also do 4BC with you guys every day up there. So if you do listen in, I'm always there. But yeah, let's dive into interest rates, because it's always a question about why, how they're used, what exactly they're for, and particularly with what we do in the property game. Obviously, we are acutely aware to the impact that they have, both positively and negatively. And so, yeah, I'm really excited to talk about this, because I don't always get to sort of step back, sort of get a little bit over the top with it. So fire away with your questions.
It's quite good timing, actually, Evan, because you're a Melbourne person, and we've just come off the back of Melbourne Cup, and obviously interest rates were held again on Melbourne Cup Day. What sort of influence does that have? And just explain to our listeners how interest rates really do determine Australia and their purpose in the economy.
So it's such a big question. Let's look at that from the point of view that Australia, along with places like Norway, you could also make some argument to, Germany as well. The reason I highlight those, we are the nations that have the highest level of variable mortgage rates out of the world. So the complete opposite is the US. So when in the US, they have basically what we got used to during COVID years, where all of a sudden fixed rate mortgages were the absolutely in thing. The US has that all the time. So when you go and buy a property over there, it's a 30-year fixed rate mortgage for the life. And if you go and sell the house, away and so forth. So their Federal Reserve, the equivalent of our RBA, they have to work much harder with interest rates. So getting back to Australia, about 80% of our mortgages are variable mortgage rate. And therefore, when the RBA moves rates up and down, we are much more attuned or acute to that change. So what they're trying to do is take money out or add money in to the economy. So if you're putting more money towards paying your mortgage, whether it's on the owner-occupier house you have or the investment properties that you own, whatever it happens to be, you're either having to put more money into that rather than doing your day-to-day stuff, or you've been given more money to actually go and do your day-to-day thing. So during COVID, obviously we got to record low interest rates of 1%. The standard variable mortgage rate got to as low as 2.5%. People were getting it for even as much as 1.5%, because they were so worried about the economy. They wanted you to have basically no overheads that were going to cause you to feel like the household was crashing. So mortgage rates and interest rates, what they're designed to do is do three things. Moderate the currency. We're not going to talk about that. That's another story. Moderate inflation, which is what we're probably going to talk about a lot about. And then also moderate the economy. Both positive and negative when I say moderate. So they need to have an economy that is sustainable, that isn't growing so fast that we have high inflation or blowing things out. They also don't want to go too hard and have an economy that's contracting, a recession. They also know that if you've got too much money in your back pocket and you keep spending, simple economics, which is supply and demand, I talk about it a little bit differently in behavioral economics, but it's the same thing. The more money you have, the more demand you can put, so the more money you can spend, putting upward pressure on price. It's that simple, because we're not necessarily generating more product. We're not, doing podcasts that can generate income, or going and buying more houses, or developing more houses. It doesn't matter. So prices go up. So if we take money away from people's pockets, less demand brings price down. And that's the cycle we're going right now. So Scott's question about yesterday, and we're obviously doing this on the 6th of November, so the day after Melbourne Cup, rates staying at a 12-year high, 4.35%. They are still suggesting that we've still got a little bit of surplus cash that's allowing inflation to remain higher than what they think is comfortable, which is between 2 to 3% annual growth rate.
It's really interesting, and thank you for explaining that to all of our listeners. I'm sure that people that do tune into our podcast may not be aware of the differences in the likes of Australia to, for example, the US that you've pointed out. And I think that's a fundamental difference in the housing markets of both countries, because people often talk about what's happening overseas and how that might relate to what's happening here in Australia. Another thing I just wanted to ask you, Evan, obviously you mentioned interest rates are used to try and control the amount of surplus money that consumers might have to spend in an economy, etc. But obviously not everyone holds a mortgage. So when we look at interest rates, obviously there's a lot of people, and in fact, I would argue, and you might have the stats on this, a growing portion of the population who maybe those baby boomer aged people might own their properties outright. So what impact do interest rate changes have on that population group?
Okay. So for those of you that are watching this live and can see my reactions on my face with regards to Melinda's question, the interesting thing right now with regards to the first part of that question about, the difference between boomers and the next generations and blah, blah, blah. I'm just going to park that for 1 second because I want to come back to it. It's a really important point around things like time and understanding time. So right now, about a third of Australian households have some form of debt, whether that's mortgage or other forms of debt on property or something of that asset requirements, also things like businesses. About a third in the property market rent, and about a third own their overall property assets outright. So they don't have that interest rate impact. Most of the time, those that don't have a mortgage also tend to have free cash, and that free cash ends up in interest repayment. So the way I answer this before we go any further, well, the other part of interest rates when we talk about this is banks. Now, banks are actually a really simple business. What they do, they borrow from you and me, put a margin on it, and then they lend it to you and me. That's all banks do, right? That's all bank does in terms of what it is. It's a really simple business, just run really complexly. And there's lots of overlays and blah, blah, blah. So what they're trying to do is give you an interest rate that attracts you to put your money with them, the margin there, and then they can go and make their money off lending that money to you and me. That's where they can't just basically make money out of thin air. They have to go and borrow it from somewhere, put a margin on it, and away they go. It's a simple business. I mean, it's like any business. They put a margin and off they go. So interest rate means that we talk about creditors. So those that don't have a mortgage tend to put cash with banks, term deposits, cash at hold, doesn't matter. The rates at the moment are at the highest they've been in 12 years. And if you look at those, about 54, not 55, about 54 is becoming the sort of inflection point between those that have seen money going backwards over the last sort of 20 months with interest rates coming up, and those that are actually seeing increase in the money that they have. So if you look at particularly 60, 65-year-olds, 70 and above, they're seeing their cash reserves expand by about 5.5 to 7%. What we're also seeing is their spending is also expanding. Now, this gets back to the other part, the boomer question. So why I want to come back to the boomer question is that this is my behavior part of me that gets into it, is boomers and their generation are very different to the generations below it, even Generation X. Why I say that, boomers have grown up during periods like we're going through now, but actually are worse. So boomers grew up with their grandparents and their parents going to war, fully expecting they would go to war. The earliest boomers would have experienced the 68 recession. All boomers experienced the mid-70s stagflation recession and then the 80s and early 90s. And not only that, during that period, you've got to remember that was when they were between the ages of 25 and 45, peak earning periods. And having a recession, I would even argue GFC, Australia got through that scot-free. We're going through a similar period right now, but they went through periods where money could be taken away like that.
Yeah.
Like literally just evaporate. So they are geared in their minds and in their behavior to property, because property is tangible. Property is much more secure, inverted commas, than, looking at, investments in equities or looking at investments in cash. They can control it better. They've got hold of it better. And that's why they have basically always seen property as the option. They've also had time. I mean, if you think about it, the 1992 recession, the one that we had to have according to Paul Keating, that's 32 years ago. It's a long time ago in terms of where we sit. And so they've had time to grow their wealth. They've had time to pay off their mortgages. They've had time to continue to grow the assets they have with a saving mindset, with a conservative mindset. Long-winded answer. But why I say that is that for those of you out there now that are looking at property prices going, I'm never going to get in, blah, 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 look at your parents or grandparents. They didn't get the house they have right now off the bat. Not only that, they've had time to do it.
I love that you have really unpacked that. It makes me actually think of something that I read in your book. And for those that do have the video, Mind Over Money, that's a copy of the first edition of the book. There has been an updated version released since then. But you talk in that book about different types of money personalities, and it almost, overlays with what you've just said. There's not only different type of money personalities, and they might respond in different ways to different economic environments and different interest rate cycles, but you've got different demographic groups, which you've just highlighted, and different age groups, and they're going to be in a different life cycle, and therefore the impact on interest rate changes is going to impact different people in different ways. And I think that's what we'll unpack as we continue with the podcast.
Yeah. So on that, let's actually just sort of have a crack at that right now.
Yeah.
The other thing to talk about is that millennials and Gen Z, for the first time in their lives, disregarding COVID, in their lives, have actually had their choices impacted. Like they're genuinely now having a choice they never thought they'd have, which is that they don't have a choice. So your ability to go and do what you want, when you want, how you want, has all of a sudden disappeared.
Yeah.
You now have, I can either go and do this or do that. I can't do both. Or it's, I want to go on an overseas holiday. I also want to buy a house, and I want to invest, and I want to do X, Y, Z. I can't. I have to choose. I have to do trade-offs. And that's the other difference that's happening. And it's where you hear the loudest voices getting those personalities, quickly go through them: saver, debtor, investor, what we refer to as an ostrich. An ostrich is somebody that buries their head in the sand and has no idea about what their overall personality is doing. It's putting that to one side. We're all a combination of both. Example, again, me. I just call myself an investor, but you and I, the two of us, the three of us all went out a couple of weeks back. And as soon as I go out, I will start buying, and I become a spender quite quickly. But I won't unless I'm in that situation. So you will jump through them. But getting back to your question and your point, Melinda, is understand that your reactions will be different. Everybody's different.
Yeah.
And right now, a whole generation, in fact, 2 generations, are experiencing something like they've never experienced before, because Australia realistically hasn't been under this kind of pressure for 32 years.
32 years. And of course, people will know from our past conversations that both Scott and I have many more years of experience on top of those 32 years. And we've actually invested through cycles where interest rates have been a lot higher than they even currently sit right now. And obviously for people that, as you've rightly pointed out, have never experienced such a rapid hike in interest rates as we did over the last couple of years, it is a different environment that they're sitting in right now. And you've rightly pointed out some of their choices are being removed, and they're having to make some more difficult choices for the first time in their life. Obviously,
I'm going to jump in again. Just apologize for the need.
That's great.
Just to flip back on the Boomer versus Millennial X competition that's currently going on. The one thing that also comes back that I need to correct the sort of the record for. Boomers talk about the fact that I went through a period where rates were double digit, right? So my home loan rate could have been as high as 18%. That's true. but you are not comparing apples with apples with right now. And what I want to point out is that the monthly take-home expenses during the peak of the 80s, 90s, double digits, as I call it, about 28% of those people's take-home pay went to servicing their home or debts. And that was the peak. Right now, at current levels of 4.35%, so nowhere near double digit, the take-home pay, the equivalent take-home pay, 32.8% is going to service that mortgage. So there is an argument that Generation Z and also millennials are right in saying that it's never been harder to service a mortgage because the amount of take-home pay is higher to service it due to the fact that the value, the volume of money being borrowed is significantly larger than what it was in the 80s. So you're talking about $100,000 versus $620,000 now. That's the difference.
I totally agree with that, Evan. I bought a property in about 1985 at about 18% interest rates. The only thing I do argue is that I wasn't the one buying the lattes and things like that. We used to have instant,
you want to go on that one too? Okay, yeah. All the avocado toast. Yeah.
I will ask, because I think that that's laid a great foundation for, some of the points that we would like to discuss specifically in relation to what's happening here in Brisbane. You've just highlighted one of the big points, and that is affordability. We are in a different environment, and the portion of take-home income that people are having to spend towards mortgage repayments is much higher across the board right now, today, compared to historical figures. However, we also know that there's going to be local pockets within capital cities, within states, within the country as a whole, where affordability based on the local demographic and the local property prices is going to vary greatly. And I think that may have an impact on how we see property price movements into the future. But before we sort of unpack that, can you just explain, historically speaking, how interest rate cuts have actually impacted markets? And if you've got anything to add that's specific to Brisbane, that would be amazing.
Yep. Okay. So I'll come back to the Brisbane part. We know historically that, falling interest rates clearly are a stimulant for property prices. That's true. But let's also look at something else. So if we look at through 2012 to 2019, the reason I highlight that, there's an argument to be made the RBA made a mistake with interest rates. So going back to our first part, the whole idea of interest rates also is to, as I said, stimulate or obviously, decrease. And they want inflation to be 2 to 3%. During that period, we forget inflation was actually below their target by quite a long way for almost 3 years in a row. So it was sitting between 1.2 and 1.8%. For those 3 years, specifically between 2017 through to 2019. There's an argument they should have cut rates there. And why I get to this is what the RBA was also watching was what was going on in the property market. So property during that period was starting to really ramp up. There was an argument to be made that already property was overpriced, that because they'd had interest rates that had basically been cut since about 2012 after they tried to do certain funny things after the GFC, where they cut rates, put rates back up again, caused a bit of volatility. And then people went into this sort of stagnant period, and they just slowly but surely edged down. And you may remember this, they wanted ammunition if something untoward happened, COVID. So they left rates at about 1% forever. And it was 37 months in a row without changing interest rates. So we thought right now, with having no changes since November last year, was a long time. 37 months consecutively. So what we saw during that period is that basically money was free, right? I know that's not true, but the RBA was trying to get you to stimulate yourself by not just buying property, but actually going out and investing in a business, starting a business, investing in the economy, and away you went. The catch is what people were doing was they were actually using it on property, which is the correct thing to have done. I mean, look at where we are now. So you saw that the economy was moving, not rapidly, quickly, but if you look also, people's wages were growing above inflation because inflation was low. People's wages were growing about 2 to 3% per annum versus inflation of 1.2 to 1.8. So real wage growth was about 1.5% because it's just the difference between your wage minus inflation. And away you went. So all of a sudden you had more money, you had the ability to invest it, and you had money for free. So where does it go? Well, property is a great example. It's a great Australian dream. And so not only that, it was during that same period that Queensland, I'm not going to use Brisbane yet, Queensland was going through a really big boom for commodities. So you look at Gladstone and what was going up at the Gladstone project, you had gas and coal going through the roof. You know, the attraction to places like Mackay was going off quite strongly. Townsville and Cairns were having great sort of tourism booms and this drive. You'd had new airlines going into those spaces. Absolutely. Properties were not just for investments, but also that holiday home that, you know, where I live in Victoria, they all wanted. All of it was sort of pushing that way. Then you had, you know, Brisbane is the hub to do the strip. I mean, you've got Sunshine Coast and you've got the Gold Coast over that, 80, 90K kilometre area, that it was attracting two folds of money, the investor, the homeowner, and then the other one that was coming out of nowhere, being the third, was the interstate investor out of New South Wales and Victoria in particular, because money was cheap and where else would you put it? And so the argument is that Brisbane therefore drove up quite quickly off it. Then COVID hit, rates went to almost nothing, and the behavior didn't change. All of a sudden, people realized that COVID wasn't going to be as bad as it was. Then you also had migration push, you know, again, my state, Victoria, mass migration up the coast. And all of that has continued, and that's now why Brisbane has a higher median property price than it does in Melbourne. And it's only continuing to grow at a fairly reasonable clip, 15%. It's only been beaten by Perth. So the attraction is there. The opportunity is there. We forget also property is a lifestyle opportunity. And then you've got the fact that from an economic, in my world, is that you had the money, it was cheap, your real wages were good, and why wouldn't you do it? So why wouldn't you? History has told you that property price has continued to grow at about 7.2, 7.1% per annum for the last 30 years. I don't have the same risk as I do with cash, or I don't have the same risk as I do with equities. Let's do it.
Yeah, good hedge against inflation.
Long-winded answer, sorry.
No, we love the long-winded answers because you never know what sort of gold you're going to deliver when you share that with us. And
you mean
and
the
I actually
rambling rubbish that's coming out of my mouth? I do apologize.
Can I just jump in? It's interesting when you look back at that, and I think we probably do forget sometimes when you talk about that time period between 2012 and 2019, and then COVID hit. I mean, who knew COVID was going to hit? And then, you know, and then as you've explained it, and look, Evan, I can sit and listen to you all day because it's just amazing how you turn things around with that behavioural side of things.
And so like everybody forgets 2012 through 19, everybody sort of just, it's like we've had like this just straight amnesia that nothing happened between it wasn't even the GFC, right? So we forget between 2007 and 2009 was technically the GFC. Yep. And that was really, you know, terrifying for a lot of reasons. But again, we got through that so much better than the rest of the world because China was absolutely at its peak and away we were going. The RBA put rates back up in 2011, and then we had the European crisis, the China hard landing story. So remember peaks, Portugal, Ireland, Italy, Greece, Spain, when the Euro crisis hit, and we almost had a failed several states. Greece, a country that's got 4.5 million people in it, was global news, and interest rates across the world were all over the shot. And again, this is what I mean. The interconnection's fantastic and beautiful because it makes my life really interesting, and I can talk about this for days. But then we had this period where everybody was a little bit cautious. Everybody was a little bit unsure. Nobody was really taking a risk. And central banks set their policy to try and get people to take risk. And what COVID did, and getting to your point, Scott, COVID brought in YOLO, let's use the Gen Z term, you only live once. All of a sudden, you know, having been locked up, again, Victorian, I was severely locked up, that people realized that they actually needed to do things. They actually wanted to do stuff. And buying a property that's either an investment or a holiday house, also was like, actually, I want that. And that was also what, if you look particularly in that sort of southwest part of Queensland, and you look at who bought it, you can tell there was a behaviour that's caused by COVID.
Yeah. So I think you mean southeast, where the Sunshine Coast links to the Gold Coast, including Brisbane. So absolutely,
I know
we
you're
saw
talking
it
about
on the
Brisbane
ground.
specifically, but the whole link through is clearly part of that whole thinking.
100%. I know that you've done a lot of work and you often present, Evan, about that mismatch right now between the number of properties that are actually being constructed and the enormous demand that's being created by a number of things, but one of those contributing factors being immigration, being population growth, being the movement of people from one location to another. And ultimately, when we're looking at property markets, the pressure of prices ultimately results from how many properties are available for sale right now, or how many properties are coming in the foreseeable future, and how many dwellings do we need to accommodate or house the number of people that are in a particular market. Now,
we don't have time.
We don't have a lot of time to cover this. I'm absolutely aware of that. But obviously, there's fundamental differences in the supply and demand metrics in different markets around the country. Right now in Brisbane, we know that in terms of listing volumes, we're actually about 25% below where our long-term trends are. So that's quite different to the likes of Sydney and Melbourne, which are on par or, in fact, a little bit more elevated. We know building approvals here in, especially in southeast Queensland, well below where they need to be based on population projections. So when we look at the fundamentals for property, the future looks bright for those already owning assets in that prices are likely to escalate. Can you help us to understand, given those fundamentals, what impact do you think an interest rate cut might have? And are you still sort of foreseeing that interest rates might be cut in the early months of 2025?
Okay. I wasn't being facetious when I laughed, but I was at the same time, because it's such a fascinating thing what governments are sort of promising at the moment around supply. So first and foremost, supply is such an interesting conundrum. Yes, construction is absolutely part of it. Scott, you know that better than anybody, considering where you've come from and what you still do. The issue is land. So that immediately becomes a local government, state government issue. You then also have the flip side of that, developed property, so actual existing property, demand and supply. Supply, and something I speak about a lot, one of the biggest headwinds for supply is stamp duty, because existing property owners see it as, it's a transactional tax, and it's a tax that, basically creates a behavior of not moving. So again, if you're a person that's lived in a certain area for, most of your life, again, let's look at the 30 years since the last major downturn in Australia, you'll want to and have developed a relationship with that area that you'll want to keep. Your family, friends will be there, but the probability that the property that you want to move into downsizing, if that's what you are, or in up to with regards to if you've got a family change, may or probably doesn't exist. Or if it does exist, there's only one of the 10 that should be on the market because stamp duty gets in the way, and so on and so forth. So the other part of it is something I talked about at the Pippa event, which is the other thing that COVID has done is stopped us from living with each other. So we have now reached a record amount of people per household on the low side. So 2.405 people per household. Historically, it's at 2.8. Now that's for the national, so it's not just for Brisbane or southeast Queensland. It's the reason I highlight that straight off the bat is that if we were to gap up to that 2.8 rather than 2.4, that 0.4 difference would actually mean that nationally we'd need around about 1 million homes less to develop. That's how big a difference it is. So again, this is personal choice. You don't want to live with each other because COVID, taught us that we don't want to live near each other. So again, all of this feeds into that question, because it's such a massive question about what's impacting supply, what's impacting, therefore, demand. Because on the flip side, so immigration and demand, first and foremost, put immigration to one side. Demand is also fascinating because, again, from the behavioural economist side, is that we can't stop time. Time always keeps going. And, the question that's starting to come up more and more in, podcasts like this is that if I could give you all the money you had to go back to your 20s, would you do it? And a lot of people would say yes, because you're never going to be healthier, stronger, freer than you are during that period of time. But at the same time, the reason I say that is that the 20-year-olds are coming up at a period where they also have to keep making choice, and they can't stop time. And therefore they can't stop time. They're going to go from being single to a couple to possibly a family to all sorts of other machinations in that space. And therefore, they are always putting demand into the system because they are having to grow. A house is a nest. They're having to grow with the house. So demand, therefore, has this behavioural side to it. Immigration, fascinating one. The government going after student immigration, in my view, is crazy because they are temporary. And they are more likely to be unit holders rather than housing holders in terms of that space. Not only that, we forget that education as an export is actually our 4th or 5th largest export. It's incredibly lucrative and we're shooting ourselves in the foot. So that's my economist hat going, this doesn't make any sense. So that's the first thing. Second thing, about 55% of international students go home. We'd love to keep them and they're staying more and more, but they are not the problem. They are putting short-term leases under pressure. Yep, true. What the government's trying to do is rent and try and control rent pricing issues. But again, they are not developing the right properties. They're also punishing property investors. I mean, again, you look at the state taxing and the changes that, we've seen former state government now for obviously for Queensland. So we'll see what David Crisafulli and co do around this. But, they were concentrating on the renter rather than actually on the supply side being the investor, because the mum and dad wasn't really part and parcel with the political side of it. So you've lost not as much as Victoria and New South Wales, but you are losing the investor because they're being punished with taxes and other things. Again, that's a supply thing.
Yeah.
If you keep hitting supply, you're not going to fix the problem.
100%. And, I think that this is not something that is likely to be resolved overnight. I think that, you were a keynote speaker at the Property Investment Professionals of Australia conference. That's where we had attended. We heard your keynote. You hit some really big issues, and these are government level issues, and nothing is going to be resolved overnight. I guess the RBA and the government as a whole is going to
bring Brisbane weather.
Bring Brisbane weather. For those that aren't watching, there's a lovely view in the background where Evan's standing for this presentation, and it appears that it's
a massive thunderstorm that's rocking up, which is great.
A storm that's coming over, and it was sunny when we started.
Evan, just very quickly, which I know you talked about this at the conference as well, and I want to go just back on it really quickly. 1 million homes less if we were to increase our household numbers by 0.4, so 2.405 per home. You said the long-term average was historically at 2.8.
Yep.
Obviously, COVID had an effect of that. What could you see that doing in the future? Do you think affordability is going to change that, and people will go back to sharing homes, increase that, because we've got a massive shortage of homes in Australia at the moment. So if we increase that by 0.4, you've just saved 1 million homes.
Yeah, 1 million new homes across the country. We're starting to see it. So it's not about the behavior, it's about force. So if the supply isn't there, force puts people back together. Rental numbers and the rental people per home is starting to increase. So it's back above 3, in fact, quite reasonably back above 3 per rental property. And we're also seeing fascinating things is that it's not, necessarily students collating together as a 4 or a 5 or 6. It's actually families. So we're seeing, the nuclear family plus grandma, grandpa starting to get towards it. There is another flip side to this. It gets back to, again, talking about stamp duty and all that kind of stuff, about why the numbers are falling the way they are. Empty nesters are becoming much more prominent. So you're talking about people that are a couple, maybe now in their 60s, kids have moved out, but they're not leaving that family home. So that family home that should be housing a minimum of 4 people is housing 2. And so they are staying in a house that could bring that number up quite quickly, because a family could move in there having 4 people and making it much more efficient. So it's double fold, is that, again, you have got force on the rental side, but on the owner-occupier side, stamp duty again, not wanting to move, living in the house you've wanted to, is bringing that number down because their kids are moving out. You've got this problem now where we keep hearing about kids living at home with mum and dad till they're 25. Well, yeah, because they can't find the property. And their mum and dad aren't going to move out of the family home into the smaller house because they don't want to. So this also answers that question a bit as well.
Maybe that stamp duty exemption for some empty nesters could be a good idea.
Yeah, so that's a fascinating question. In terms of policy, it's only for 12 months, and it's only for new properties. It's only for apartments. I mean, Australians don't want apartments. Again, you guys know this, and everybody listening know this better than anybody, is that you look at the trends. Australians still want to have soil underneath their feet. And you cannot change an apartment, right? If you're a family, it's so hard to have an apartment as something. And not only that, the other thing I think I spoke about before, and I'll say it again with those numbers, is that apartment, though how long we hold them for is about 5 to 6 years, whereas a house is between 10 and 13 years. So it's a transitory hold as well. We don't hold it for very long. So it's not the answer. Helps, but not the answer.
It's not the full answer. Look, I think that what we've been able to cover today or unpack is the fact that, interest rates per se, it's not the only lever that that influences housing formation, that influences property prices, etc. You're wanting to say something?
Yeah, you asked me before where I think interest rates are going.
Yeah, I did.
I'm really sorry. I didn't answer that, but because I'm going to interrupt you before we wrap up. I'm going to really disappoint people here because, again, I'm a behavioural economist rather than like I used to do the economic stuff, don't get me wrong, but I'm now going off the behaviour of the RBA rather than everything else. Yeah. And all things being equal, what they are telling you, rates are going to follow what happened in the US this year for us next year. Expectations was early this year for rates to cut in the US. It didn't happen until September. Expectations for 2025 is for rates to start cutting in early. The RBA is telling you, do not think that way. And my view is June. And the reason I've got June, February now looks very unlikely with the inflation numbers that we've just seen and the RBA reporting on Melbourne Cup Day. So the next one is February in terms of the meeting that has inflation after it. That's unlikely to get to where it needs to. If they're forecasting at 3.4% for core inflation, trim mean, it's not enough to get them. April and May is a problem because April the 1st, which is the meeting after the one in February, the Prime Minister is probably going to be walking around the Government House and dissolving Parliament to call an election. The next one is May, and that will be the Tuesday before or the Tuesday after a federal election. So the RBA is likely to sit on its hands again, not trying to get involved in the politics. The one after that is mid-June. And that's my view about when rates will actually probably see the first cut. Disappointing, I understand that. But this again gets back to everything we've discussed over the last 35, 40 minutes is inflation is humming along higher than we need, and we've still got too much excess demand. Sorry.
That's great. I mean, you've given a forecast, and I think that media commentary in general is alluding to the fact that this rate cut might come sooner than that, and therefore it's great to hear from someone that's in the know what your expectations are, because there's a lot of noise out there around interest rate cuts, and a lot of people associate interest rate cuts.
All that matters. It's all that matters, and they are the ones that are the gatekeepers, whether you like it or not. They are telling you that they are not ready and they don't think the country is ready for it.
So I think that also, tells the story that people should not be banking on interest rate cuts. If you are making a decision about property today, absolutely do not rely on those rate cuts coming through. And this is something that as buyer's agents and property investment advisors, we're always very cautious about warning consumers about a worst case scenario. And the worst case scenario is that we won't see a drop at all. Or in fact, let's look at what happens if something changes in the economy and we see interest rates increase, because these are the realities. Things change. It's very likely that we're going to see the movement down as the next movement, as you pointed out, but it's always important to have, a view of what if scenario would look like as well.
Yeah. And so again, I'll get back even further. If you're investing in property, it's not for the next year. It's not for the next 2 years. It's for 10, right? So interest rates should not be necessarily just the only thing forming your view. And so you need to have, is exactly as Melinda had, that absolute foresight about why you're doing this and how long you're going to be involved in the investment that it is, whether it's for your owner occupier, whether it's for an investment, it doesn't matter. This is an option that you're taking that is going to be what we refer to as a long-term view. Once you go above 7+ years, it's a long-term view. And that's where you should be looking. Where's interest rates in 10 years, not where's interest rates in next June or even as low as Christmas next year.
Brilliant advice, something that we always share with our clients as well. But I feel that there's a lot of people that are after the immediate uplift. They're looking at what we can achieve in the next 12 months, whereas the reality is that property is a long-term asset class, and people need to lift their head and look out to the horizon to see what can this asset do for me over the next 10 or 20 years.
Mm-hmm.
Evan, how do people get to listen to you at 4BC? Just so that our local listeners up here in
What time
Brisbane,
are you on?
When are you on 4BC?
I'm on every day at 12:45-ish with Sophie Formica through to about 1 o'clock. Normally I get 15 minutes with her. So I'm on there every day. Sometimes I miss Fridays because I do other things, but 4BC is where I always tell I'm pretty much having the same discussion that we've just had. Sophie and I have basically back and forth discussions, sometimes robust, sometimes conciliatory. So yeah, if you do want to listen to me, I sound exactly the same there, and certainly try and put some different views out into the world of 4BC business.
I would suggest if people are available around that 12:45 daily, jump onto 4BC, and also the book, Mind Over Money, as we've mentioned earlier, and have a read through some of that information. We've only just touched the surface today, I feel, and as I said earlier, Evan, we could probably chat all day, and look, we'd love to have you back again sometime. To talk
I was about to say, I love doing this, and would love to be back if you will have me. I very much enjoy having these kind of talks, and hope those out there listening really enjoyed it. What I'd also say, if you've got questions, fire them off to Melinda and Scott. I will come back to them. Get involved with what they're doing. They are doing very good things up there. So please get involved with them if you've liked what we've done, and I'll answer what I can from you as well.
Perfect.
Thank you for the plug there, Evan. That wasn't, we didn't ask for that up front, so we appreciate that a lot. And for those that do want to reach out, it's info@streamlineproperty.com.au, or head on over to our website and make an inquiry at streamlineproperty.com.au.
Yeah, and as Evan said, I'm more than happy if people want to throw some questions in. Put them in. We'll organise a time with Evan, and we'll run through some questions. It'll be a bit of a Q&A, so that we can answer some questions for some people as well. Mate, thank you very much for taking your time. You've come out of the beautiful weather in Melbourne to come inside to have a chat with us. We've got that weather pretty much every day, except add a little bit more humidity.
Disappeared now.
And that's about what you get in Brisbane. A lot of humidity and those storms rolling in at the moment. So, look, really, really appreciate your chat. As usual, I will let Melinda wrap things up. From myself, thanks very much for listening. Evan, thank you again, and take care, and bye for now.
Yes, thank you for joining us, Evan. It's been an absolute delight having you on our show.
Thanks for having me, guys. It's been an absolute pleasure, and looking forward to speaking to you in the future.
Brilliant. Sounds like a plan, and we will lock you in. So if you have enjoyed today's episode, as always, we would love for you to leave us a review, and don't forget to share this episode with friends and family. As Scott's pointed out on the 4BC 12:45 daily, you will be able to hear Evan's perspectives on the economy with that behavioural twist, which I think makes it all that more real in today's society. We hope you've enjoyed this episode, and we look forward to speaking with you again soon. Until then, bye for now.